This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a segment of Mackenzie Investments, the Invested podcast. My name is Dustin Reed, I'm the Chief Fixed Income Strategist at Mackenzie Investments. Today, we're going to focus on current market events and what they mean for markets. We've just recently had both the Fed and Bank of Canada decisions. But before we get into that, I would like to talk about what's happening globally in terms of geopolitics, oil prices, energy infrastructure, and how it's impacting markets, and then subsequently what is happening across numerous central banks around the world, including both in Canada and in the US. We've obviously had a significant few weeks since we last spoke on this podcast with a significant escalation in hostilities in the Middle East. As everyone knows, oil prices and energy prices broadly are significantly higher than where they were a month ago. This is causing a significant amount of disruption in markets across all asset classes. Equities to a point, fixed income absolutely, definitely in the FX market and absolutely in the credit market. And of course, we're seeing a lot also reverberate through the commodities market. Our view on the fixed income team is that we could see some continued hostilities for a prolonged period of time. Energy infrastructure now across the Gulf continues to be targeted. And we're thinking about the idea of shut-ins for refineries and for gas fields that may not be operable for quite a while. Early in the hostilities, we heard from numerous Gulf countries that they were not going to repair their facilities for energy production until the hostilities ended. And that has only increased over the last couple of weeks since hostilities began. That seems to suggest that we are going to be looking at less supply of both oil and natural gas for a foreseeable future. And we're recording here on Thursday morning, March 19th. Just this morning, we've heard from Qatar say maybe arguably the most significant thing around capacity that we've heard year to date or to date on this particular issue is that they're going to maybe enforce some force majeure metrics on some of the fields, and that might impact contract supplies and contract negotiations for the next 3 to 5 years. And that's quite significant. Most of the discussion that I've heard within the market has generally been weeks or months. And for Qatar to talk about the idea of having a force majeure and not enforcing contracts that are due for the next maybe 3 to 5 years, and that's still speculation at this point, is very significant. And I think the market is looking at that as a significant escalation in terms of what will happen in terms of the price of oil and the price of LNG going forward. So far, we've seen, particularly the oil curve, and I guess the LNG curve as well, in significant backwardation. And that basically means that the front contract, the near-term prices are significantly higher than the prices 3, 6, 9, 12, 24 months out. And that curve structure continues. But with announcements like the one I just mentioned out of Qatar and a lot of the infrastructure or some infrastructure getting shut in with in Dubai and UAE, Bahrain, Iraq, Kuwait, a few other GCCs, you are starting to see the back end of the curve, if you have a 24-month outlook, start to move significantly higher. So we've seen the 6 and 12-month contracts in oil and nat gas start to move significantly higher. So I think that this is going to be an issue for markets, obviously already an issue, but it's going to become more and more of an issue. When hostilities broke out a few weeks ago, the market immediately moved to trading this as an inflationary event. Yields were higher, equities lower, generally a safe haven bid for the dollar, and credit spreads wider. We also saw significant repricing for central banks, with markets starting to price in hikes across particularly the G10 space, but also some in the EM space. And that has also been a significant issue for various asset classes across the globe. At some point here, if we continue to see higher energy prices for a prolonged period of time, that thematic of markets trading off an inflationary theme will rotate away from inflation and towards downside risk to growth, or as we would say, maybe growth destruction or aggregate demand destruction. It's probably the question in markets right now. What would it take for the market to flip from trading this inflation thematic to a downside growth thematic? I was in New York for a few days last week, speaking with a number of people on the macro side. And the takeaway that I had was that we would need to see Brent oil, which is generally considered the global benchmark, trade around $120 per barrel for at least a couple of months, if not a few more months, before the market started to trade away from inflation as a thematic to downside growth risk as a thematic. I would probably be a little bit on the earlier side than that, both in terms of price as well as in terms of timeline. And you can even see today in today's market on March 19th, particularly with some of the curve moves where you have 2-year notes up significantly in terms of yield, but you actually have 30-year bonds in both the US and Canada actually lower in yield today. And that's with a significantly higher move in Brent oil that will probably end up being the high close of the cycle when we close later today. So that to me is significant, and that price action is significant. So I think we are slowly moving, ever so slowly moving away from the inflation side to the downside growth risk side, but it's still early to probably capture that theme. And I think that's a very, very important thing for all investors to keep an eye on, whether you're an institutional or retail investor, whether you're an advisor. This is a very, very important thematic here because I think if you believe that we are going to be looking at some sort of hostilities and elevated energy prices across the complex for a while, we will very likely migrate from that first theme, inflation, to the second theme around downside growth. Central banks are in a very tough spot and have to deal with this, right? You have a Canadian central bank that obviously is price focused in theory only, and you have a US bank that has a dual mandate, obviously prices, as well as trying to foster or maximize full employment. Maybe I'll take the Bank of Canada first, and then we'll move to the Fed. Bank of Canada meeting this week, not a forecast meeting for the bank. Bank held rates at 2.25%, as most people expected. Everyone was very, very interested to see what the bank would actually say and do, given the obvious. I mean, it's generally known that Canada is an net energy exporter for both gas and for oil. Some of that goes to the US, some of it goes globally, of course. There is still a debate, I think, whether the net impact on the higher prices across the energy complex is quote unquote good news for Canada overall, or it's bad news for Canada overall. From a revenue perspective for the government, it's clearly constructive. And the government, I think, is expecting to take in more in terms of taxes and revenues into its coffers from a fiscal perspective for the current fiscal year, given the move. That said, it's very clear that a lot of households are going to have a very, very difficult time with this higher energy prices. Obviously, it feeds into everything. It feeds into price at the pump. It feeds into food prices in terms of transportation and getting food to the stores, final goods. Everything is really affected by higher oil prices. And many people have heard this discussion over the last year and a half around the K-shaped economy. Those that are in terms of middle income or lower income, those households are going to have a particularly difficult time because disposable income here is clearly getting squeezed. And some of the necessities of life are becoming more and more expensive. And so, from that perspective, that's clearly not particularly constructive for the economy. So, it's not necessarily a one size fits all, even with respect to Canada. The bank was very focused on talking about both sides of those issues exactly as I spelled out. I was a little surprised that the Bank of Canada led the end of its statement, its last paragraph, with the idea of downside demand destruction as the main risk. The key takeaway I took from the bank overall when I looked at the statement and then I listened to Governor Macklem's press conference was effectively we're a little bit more concerned about downside growth than we are about inflation. We're prepared to look through upside inflation in the short term, although we're not going to let it get out of control and let it broaden out, their words, if it lasts for a long time. But the banks seem to be emphasizing a little more concern over downside growth risk. As many people know, we've been focused on the Bank of Canada cutting rates before or at the June 2026 meeting. And the moves in energy prices, I think, probably take a little bit of risk that will not happen before June. That said, I heard enough from the bank yesterday that did not cause me to change my forecast that the bank still could cut by June this year. And meanwhile, the market continues to price in more and more hikes for the year. So I'm becoming, even more out of consensus with where the market's pricing. Yesterday, I heard from the bank that it is even more concerned about the Canadian housing market than it was at the January meeting, which was a forecast meeting. Obviously, the latest jobs numbers out of Canada were not particularly constructive. The February numbers that showed a loss of 80,000 jobs that we got earlier this month in March. The inflation picture, at least the core inflation picture, continues to come lower, although we are clearly in line for a significant spike in headline inflation when we get the March numbers in early April. And then, of course, USMCA hasn't gone anywhere. And I think that the risks around USMCA that I've been focused on for the last number of months and quarters are still very much there and present. And I'm concerned that we will not necessarily come to quote unquote a deal, and some supply chain ruptures could happen. And that would clearly not be great for aggregate demand for Canada. And I would actually add one more thing that I didn't list off before. We just got the population figures for Q4. Recall that the Q3 numbers in Canada saw a minus 0.2% change to the population, so a slight decrease in the overall population. So Q4 also saw very little population growth again. And I think that's continuing to have a significant impact on aggregate demand and household consumption that will continue to drag the overall numbers down for Canada. So this idea that we're seeing big moves higher in energy, I mean, obviously we're spending a lot of time thinking about it and looking at it, and it is very, very important to markets. But I wouldn't necessarily run to the conclusion that the fundamentals are going to be tossed by the wayside. The bank is not necessarily going to adjust rates lower later this year. Maybe June ends up being a little bit too early, but I still think that that is somewhat possible. Switching to the Fed quickly, you won't hear me say this too often, but the Fed meeting probably takes a little bit of a backseat to everything else that's going on, and probably not as big a deal meeting as would normally be the case, even because it was a forecast meeting, of course, for the Fed being a March meeting. So no change, obviously, on rates by the Fed. That was obviously well expected. Very little changes in the statement. Only one dissenter, Moran, no surprise. But Waller and Bowman, Governors Waller and Bowman, did not dissent and were relatively comfortable with the move. The SEP, the Statement of Economic Projections, the forecast round, so to speak, had a few little interesting things in it. Most people, including myself, were looking for a pretty big increase, what I would call a mark to market on the inflation outlook, both on the headline and core perspective. When we did get that in the outlook, and that was pretty obvious given the core PCE and PCE numbers that we got in December and January, and sitting here today, the preliminary estimates that we have for February, but we don't have the entire data set yet. But it looked like there needed to be a mark to market. Fed was looking at around 2.5% before, and that needed to come up closer to 3%. And that's what we got. We also saw a change to growth outlook, actually higher. And maybe somewhat interestingly, for those that are always looking at R star, or what is the neutral rate of the economy, R star was actually increased by half a tick, let's call it, from 3 to 312 or 312 and a half. There's a great debate happening within economic circles right now, which I'm sure many people have heard about. Obviously, everyone knows the AI story and then the AI productivity story. And there's two schools of thought around that. One is that AI productivity is going to cause job losses, decrease aggregate demand, rates need to go significantly lower. And so R star, or the neutral rate for the economy, needs to come lower. And there's a second debate, which kind of came out a little bit after that first line of thinking. And that's effectively that because there's so much CapEx being spent on the AI build out, data centers, et cetera, that the demand for labor, electricity prices, kind of the multiplier effects, all those things actually increases the neutral rate of the economy higher in the short run. And so it was interesting to me that between the December SEP, Statement of Economic Projections, and the March one that we just got, and we all know the AI story and the amount of CapEx and all the news flow that that's been capturing over the last few weeks, that the Fed actually upped its neutral rate by half a tick, half a dot. A full dot would have been 3 to 3.25. So it went from 3 to 3.125. And I think that's quite interesting. The Fed is not looking to make any major moves for a while here. I don't think they're going to be cutting rates. I don't think they'll be hiking. And to be fair, last year, one of the things that we were looking at for 2026 was that the market was pricing in way too many cuts for the year. I mean, at some point, it was pricing more than 50, 60, 70 basis points worth of easing. Today, actually, with some of the news flow obviously coming out of the Middle East, we are now looking, the market is now not pricing any cuts whatsoever by the Fed for 2026. And Chair Powell did say at the press conference that there was a little bit of discussion around what hikes might look like, but that seems to be a very, very early discussion, I think, at this point. So the market is coming our way on that again, but obviously a lot of that is given what's happened in the last few weeks out of the Middle East and oil prices higher. But the AI CapEx story, I think, is also playing out. So in terms for markets, I think there's a lot of implications here in the next little bit. Again, I think the market's probably been way too hawkish on the bank, particularly in the short end of the curve. So that needs to come down, and probably a little bit less so, but directionally correct on the Fed side as well. Again, not to repeat, but the big thing for markets here, for all markets, is going to be this rotation away from inflation towards downside growth. If the back end of yield curves are bid, so prices higher, yields lower, on concerns over global growth or domestic growth in US, Canada, or otherwise, that has significant implications for equities, has significant implications for credit, and will have significant implications for FX markets. So that is the thematic that I think everybody should be watching for at this point in time. That'll wrap it up for today for Mackenzie Investments Market Exchange podcast. We welcome your comments and questions and look forward to seeing you next time on Market Exchange. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.